This is a time where you wouldn't normally see this much rally this quickly.
Welcome back to the Comstock channel. I'm Marlin Bohling with you. Glad to have you with us as we wrap up another week of trade. Going to bring in a little extra help from Relph of Comstock Investments. We'll analyze what took place on Friday and what the overall trade meant for this week. Eric, as we look at the action on Friday and the grain trade, corn not so great. The wheat market had an extremely wide range, but closing near the low of the day. Not sure what that means here. And then on the soybeans, you had strength in the nearbys, but maybe not nearly as much in the deferreds, the new crop month. So
Right.
let's take these one by one and talk about them here. The big movers seem to be in the wheat. And the wheat tour is over. The numbers all came out, and it's like the market doesn't know what to trade now.
Yeah, that's and you can get a mixed bag of emotion. You can get a mixed bag of inputs depending on where you're looking and what you're looking at specifically. I mean, the wheat tour isn't unprecedented that time period creates a seasonal high, and that may be what we saw this week. And in fact, right now, the chart action would indicate that is what we saw this week. But of course, a week doesn't make a market, so we'll have to see what happens here moving forward. The big caveats that we have still out there, the what ifs, revolve around Black Sea and India. Russia, Ukraine, growing region problems persist. That is supposed to improve in the coming days and weeks. However, the idea that India could still come into the market and be buying this from exporters around the world lends a little bit of underpinning to any potential weakness. And so, a lot to figure out here still while we're beginning harvest right now in the U.S. And so this may be a time where we start to see some pressure domestically on that front. So again, a lot of balls up in the air, but the wheat has been pushing the corn whichever direction. And that was true today as the wheat traded from double-digit gains to double-digit losses in the same session and pulled corn both directions with it.
Still makes me nervous that in Chicago, July wheat, you had it going and testing a 62% retracement, at which point it seemed to run out of gas. Kansas City wheat went up to 50%, and then it kind of crashed and burned after that. Technically, it just is not a good look overall right now.
Right. And for whatever reason, the last couple of years, well, really ever since Russia invaded Ukraine, the wheat has been overly technically traded. You do get day-to-day shifts due to fundamental inputs. You get word that Egypt's shopping and that Russia's prices are high. And I'm going back a while, obviously right now Russia's not high, but those kinds of rumors go around. Well, then U.S. wheat gets bolstered, prices move higher. Same with Paris milling wheat. And then you find out that Russia cut prices, Egypt issues a large tender, buys from Russia, then our prices fall. And so once in a while you get these fluctuations from that. But aside from that, this has been a very much technically traded market, and we're seeing that still today.
Well, it's been a long bear run in the wheat market, but it did have a nice bounce here for the last month and a half or so. Were we actually overbought in the wheat short term?
Oh yeah. Mm-hmm. Yeah. On the daily charts, you look at any oscillators and we had gotten into overbought territory across all three classes. Really. This was a reason that we put out as a firm to get some additional hedging done. And right now, we've got, I feel pretty good about our coverage levels. We're about half hedged at $7 average for the KC growers, which is the bulk of our wheat clientele. And so I feel pretty good about that. I think that's a nice number. Everybody's going to do okay there. So we'll continue to look for any other opportunities moving forward. But again, I think they're going to have to be foreign driven.
I know Joe Camp and I were talking about it earlier this week when the wheat tour was getting underway, and about the seasonal tendency for the market to maybe act a little toppy when that wheat tour finishes up. And we kind of cautioned everybody about that. And dang, if it isn't doing it again, we'll have to see what happens next week here. On the other hand, you were mentioning earlier that wheat does seem to have an influence on the corn market. How so?
Well, obviously grains in general, that they kind of have a flow to them, and a lot of times you'll see spread trading between the oil seeds, and which in the U.S. is soybeans, and the grains, and we saw a lot of spreads slowly being put on over the last several weeks. That was long grain, short oil seed. And this week, for whatever reason, prompted traders to unwind that. And so you saw the soybeans, the beneficiary, while the grains as a whole, including both wheat and corn, it was to their detriment. And so you saw corn and wheat suffer while beans were kind of rallying here. And then oats, the old caveat, the wives' tale of the oats know where the corn goes. I hope that's not the case now, because oats was limit down yesterday and pushing real close today again. So I hope that's not a sign of what's to come in the oats in the corn in the coming days.
I'm glad you brought that up. That used to be something that when I was on RFD TV, we used to kind of keep one eye on that all the time. And I mean, yeah, it is an old saying in there, but what is it? Is it rain in the northern areas that's driving that oat market down? What happened there?
Yeah, well, I was a little surprised by the strength that we saw coming off of lows several weeks back, and we had kind of mounted a rally where it got into areas that I thought, if we're truly going to have more acres in Canada like what we've heard, then there's no reason really for the oats to be much higher. And then they just kept rallying, and actually superseded my expectations by a long ways. But then we come and rip 50 cents out of the market inside of a week, and it's like, man, this is just killer. So that, I think the big deal is that Canada's conditions are maintaining, their acreage is up, and I don't know if it was fear of wildfire spread or what, but they were expecting something different, and it didn't come to fruition. And it's primarily centered around the conditions in Canada.
Make sure you like this video, subscribe to it by clicking on that bell icon down below, and share this video with others as well, as our audience continues to grow thanks to you. Trading oats versus trading soybeans used to be like trading silver versus gold, the way it seems. In fact, looking at soybeans today, what is the deal here with the big spread change between the nearbys and the new crop? What happened there?
I think that's where you had your spread activity against the grains was in the old crop. And that's why you saw that old crop really outpacing new crop here coming into the week. And the reality is if traders are looking at this logically, and even fund managers who they favor the front end, they always do. And that's why in a bull run, we'll see the front end outpace everything else. And we call it bull spreading for a reason, right? And so, this is a situation where maybe we have some issues, aside from the spread activity that I already mentioned, but maybe we have some issues that are going to impact the bean availability early in the season, which would be old crop, versus if we do dry up over the next couple of weeks, the beans still get in a nice, timely manner, adverse to the corn, in a lot of these wetter areas, then the new crop could still be absolutely fine. The problem I have with that theology is if we do shift to a La Nina midsummer, it's really going to impact the beans, because we're going to be in full bore La Nina by the time we get to August, which is when it matters most for the beans.
I had heard the other day that basis had kind of started to crash in parts of the Midwest. Mm-hmm. Have you heard the same thing? And if so, what's behind that news?
Yeah, so this is probably going to go down a rabbit hole that we maybe don't want to go down, but should. So we looked at the commitment of traders report, and the funds had liquidated far more corn positions than we thought in a fairly short amount of time. I think we liquidated 115,000 in a week, and then we'll find out here in a couple hours what they did again by Tuesday of this week. But the fact that they were able to liquidate 115,000 contracts Tuesday to Tuesday and move the market about 7.5 cents during that time frame would indicate that there was a ton of farmer selling during that same time frame when the funds were liquidating those shorts. So the funds are buying, the farmers are selling. It just almost offsets each other. You don't get a ton of market movement out of it. The problem is then you had a lot of basis getting locked up when it was still in a lot of areas, especially here regionally, you had 20 to 30 over basis. So you had basis getting locked up, and they know they're going to be planting soon if they're not already. And so grains moving, I mean, big time, all over the place. It's getting sold rapidly. And so they're just getting their needs met. And maybe they already have the basis, they're dropping their current bids because they've already got so many basis contracts written for whatever length of time. But the reality is they've procured the grain now. They don't need to bid up anymore. And I think that's why we're seeing the continued weakness even after that fund liquidation. And in my opinion, the funds probably got net neutral prior to this last slough off, where we had 3 days in a row where we're down a nickel.
Let's take the blinders off here and look at the broader picture. That brings to mind the thought that there was an old saying when I first got into working with the markets a few decades ago, let's say. They used to tell me that you cannot stage a major rally until you get the majority of grain out of the farmer's hands. Are we getting there?
I think we're getting there.
Really?
I really do. I think prior to this onslaught of selling, we had farmers, as a blanket statement, I hate doing that, but I would say, I guess let me rephrase that. Based on our clientele, I would say farmers were somewhere in the 35 to 50% sold range prior to this onslaught of selling. And now we're definitely majority. Is it 60%? Is it 85%? I don't know, but there are a few, unless they're just chronic holders, meaning they just don't sell until they get that opportunity every 3 or 4 years. You know what I mean? There are those people out there. But aside from those folks, there are very few that want to hold into the heart of summer. Everybody wants to be sold by the 4th of July. It's just kind of a rule of thumb. And a lot of people follow that. And so I think this has given enough rally, enough basis contract locking to where we're going to see a lot of the old crop being sold now, and then we set the stage for summer weather.
Let's shift gears. Let's talk a little livestock here. The cattle market on Friday stole the show. How come?
Oh, absolutely. Yeah, it was the cattle market was the biggest story of the week. It just kind of was lingering in the background a little bit, unless you're one of those that pays real close attention to all the fundamental inputs, because box beef was just on a tear all week. I believe it was Tuesday. Well, rewind. Monday, we came out, we rallied sharply, but we gave it all back. Tuesday, we posted really nice gains. Feeder cattle up $4, fat cattle up $2.50. So everybody thought come Wednesday, we're going to strip this back. And we didn't. We just held right around steady. You know, you were just kind of uneven on Wednesday. Thursday, you stack on a little more gains. Then Friday, really pack on the gains. And that was driven by first box beef. Box beef, choice cuts put on $18 this week. Select wasn't far behind. Huge gains in box beef. And then cash cattle, because of the beef gains, feeders were holding out and packers were having to get a little aggressive. And I actually heard of some instances today where multiple packers were in contact and they were literally almost on a conference call as quickly as they're calling each other back and forth between the feeder and the two different packers that are bidding on the same cattle, going $3 dressed. That's $5 higher than last week. We had some 190 live cash reported in Iowa, but I think we're going to see a national average of something like 188, maybe 187 at the low end, depending on what Kansas and Texas do to finish the day here today. But regardless, you're going to see $3 to $5 gains in all negotiated cash cattle on the Fed side. And the feeder index just really couldn't get going. We've known that feeders were overpriced by comparison to the fat cattle. They weren't, we've talked about this on here before. They just weren't penciling quite right because of what guys were having to give for these feeder calves. And now you've got some correction in that, and that seems to be straightening itself out. But we've got to keep in mind that there's always problems. You can't just go up forever. And so you have to look at what are some real objectives. And we hit some of those today, in my opinion.
Now, we were talking before we came on to record this here. You were looking at moving averages. I believe live cattle touched the 200-day moving average. Let me look here. I believe on feeder cattle today, looks like it's hugging the 100-day moving average. Is that right? How important is that?
It's very important, especially when you've got fund money within these markets. So a lot of the spec longs are with these larger traders, and they look at all the technical inputs and they program their algorithms accordingly. And I think that's why we saw, I don't want to say failures because we didn't just fully retreat, but we couldn't hold right at the highs because the highs were those moving averages. And I think there were orders sitting there to sell. It's just long liquidation, profit taking. I don't think we're going to see a bunch of speculative shorts come into this market or anything like that. But now you're staring down a board where you've got 188 plus in the February live cattle, you've got 190 plus in the April live cattle. You can do a lot of things with those numbers, and that works. And so that is going to attract some hedge pressure. I just don't know if everybody's going to be on board to do it right away. Most will miss the high. It's just the way it goes. I just don't know where that high is going to be. But I think this is giving an opportunity to pencil out some of these really expensive feeder calves, and we haven't had that opportunity very many times.
How abnormal is it to have a cash trade rally like in the boxed beef market this time of year compared to what we normally would see? I mean, is this kind of normal or not?
This is a time where you wouldn't normally see this much rally this quickly. I would have expected to see this kind of move in box beef over the past 30 days, not now. It seems that packers are probably under contract. They're underbought, leading into what is now one of the biggest seasons of the year. And it's going to be compounded this year too, because we just haven't had the weather to get out and enjoy it in a lot of parts of the country. It's either been cold or gloomy or rainy or windy or whatever. And now you've got everybody just standing at the door ready to throw it open and go outside and do something. At the same time, when you've got Memorial Day right around the corner, you're just getting past Mother's Day, you're coming into wedding season. There's just a ton of stuff stacks up here. And I think that demand, the foresight of that demand, is really driving this thing here recently.
So looking at it from the wholesale side on the beef demand, okay, so we're kicking off the start psychologically of summer,
Right.
with Memorial Day coming up, and that will normally run through Labor Day, let's say.
Mm-hmm.
When at the wholesale level do they finish up their buying for, let's say, Labor Day? When do you peak out that demand out there on the ranch?
On the ranch?
Well, from the feedlots. I mean, when the
Yeah.
wholesaler has to acquire the needs to process it and everything and get it into the retail channels for Labor Day, let's say.
Yeah.
How long do you think this could run?
August is always a trash month. That is usually the time when you see this thing slough off completely. Everybody has a different word for it, but August is definitely the time frame when you start to see this thing fall apart, for both live cattle and feeder cattle. And so how soon that'll depend on cold storage. You talk about the wholesale end, that's going to depend on cold storage. It's going to depend on packer procurement and how they're moving things through, what the chain speeds are like. We've been hearing threats over and over and over about how, especially from Tyson, they're going to cut back to 32-hour weeks. No Saturday kills. They're going to cut back one shift. They're going to do this. They're going to do that. So far, they haven't cut back anything. The kill's a little lighter, but they're still running the same tonnage because the animals are bigger. And so, it seems like idle threats. They could do it at any time, and that would change things a little bit. But right now, they can't get any cattle to kill. So they're probably going to have to cut back to some degree, just because they're unable to get the supply. And that, when you end up, like I said, when you're on back and forth phone calls with the same producer trying to buy the same cattle, and you're talking about two majors bidding, that's a pretty dire market.
Now, on the lean hogs, we did not have a great day, but when you look at a daily chart, it looks to me like we have come down from the high here about a month ago and hit a 62% retracement level for a support line, and it looks like maybe it held, even though we were down on Friday. Is that kind of a positive look to that chart on the hogs?
It is, especially with beef doing what it's doing right now. I mean, eventually they're going to price this beef to the point where you're going to start to damage demand. You're going to start killing demand soon. Those that aren't bought up, they're going to buy what they want for whatever set amount of time, and then they're going to look for some value products, and pork fills that need. So while, again, this is a situation, we talked about the cattle and the hogs going in opposite directions, the beef and the pork could go in opposite directions too. As that beef demand gets killed off a little bit, the pork should pick some of that up, and that should boost things a little bit, and we should see some increased pork demand over the next 30 to 45 days once we get past Memorial Day.
So I had someone inquiring of me here in the last couple of days, from the livestock producer point of view, are you waiting for the grain markets to maybe slide a little bit more before you lock in some more feed needs, given the price of cattle right now, for example?
I would say most aren't. prior to this calendar year, so I'm talking 6+ months ago, I think everybody had in their mind that these cattle are going to be eating over $5 corn, right? We're going to have to, if we can feed $5 corn, this works. And they're able to achieve that still fairly easily. And, obviously it gets higher or cheaper depending on where you're at in the world. But I would say those that don't already have it locked up, you've probably got a window here for the next 30 days or so if we are going to truly shift into a La Nina, where you could get some grain bought. But we also have to keep in mind this situation that we're dealing with here locally with regards to the ground conditions. We're not planting anywhere right here right now, and this is premium ground in Northwest Iowa. This is the $27,000, $28,000, $29,000 an acre ground that makes 260 bushel corn, and we don't have planters rolling. We're less than half planted. We have rain forecasted for Sunday. We have another system forecasted for Wednesday, and prevent plant begins June 1st. So we're running against the calendar really hard right now. And Nutrient Ag has already come out with their first estimate on the corn acreage, and they're running 3 million acres behind what the USDA last printed. And so there's several things moving forward here that could change the balance sheet on the corn significantly and run these prices higher. So do you wait for a lower slide with all those potentials on the horizon? Or do you buy 465 to 485 corn now when you were penciling $5 before the start of the year anyway, when you were working on your balance sheets? I'd say go ahead and get it bought now.
So maybe more hand to mouth would be appropriate right now. At least you can lock it in.
At least right now. Yeah.
Yeah.
I think you're going to have to get some contracting done sooner than later, but right now I think you can stay hand to mouth.
Okay. Anything on the energy markets that caught your attention on Friday?
We're staying right under the Biden ceiling on the crude oil. So as long as we do that, we can keep refilling the strategic petroleum reserves and all will be well, I guess.
Okay, Eric. Well, thanks for all the time and for talking with us here as we recap this past trading week. And we're going to be getting closer here within about, 2 weeks of the Memorial Day weekend now. So anyway, then it's going to be summertime. So a lot to talk about. In fact, you and I had been talking, a couple of days ago. You had mentioned something about people that have been talking with you about the LRP. Mm-hmm. That there was actually something that came into play here a couple of days ago. Is that still working or not?
Oh, yeah. And actually, we're going to have that opportunity again today. The floor on LRP is set based off of the board price. So every day that the board's up, the floor is up. And what changes, though, is the price actually goes down on up days because the skew is to the top side and you're essentially getting downside coverage. So downside coverage becomes cheaper on an up day, even though you're getting a higher floor on an up day. So it's just kind of a perfect storm there where you can get the best of both worlds, a little cheaper price and a higher floor at the same time. And so we've been taking advantage of that on these bigger moves higher on a day-to-day basis.
Sounds like you've been getting a lot of inquiries about that here lately now.
For sure. Yeah. Like I said, these prices are attractive and they work.
Okay. So if we have somebody out there interested, how do they get in touch with you?
You can call the office at 712-227-1110. You can send me an email at ericr@comstock.com, or you can go to the website and get in touch with us through there.
Awesome. Eric, thanks. I appreciate that. You have a great weekend, sir.
Thanks, Marlin.
Eric Relph of Comstock Investments with us. That'll do it for this episode. For producer Brian Hedrickson, I'm Marlin Bohling. We'll catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.